Welcome to This Explainer. Today, we're going to jump right in and objectively decode the Cerebras Systems IPO. Now, if you've been paying any attention at all to the markets lately, you already know that AI is the absolute center of gravity right now. But today, we're going to cut right through all that AI hype. We are going to take a hard look at the undeniable technological momentum of Cerebras, but we're going to weigh it directly against some, well, pretty extreme fundamental risks. It's time to separate the narrative from the actual numbers. Let's kick things off with an absolute monster of a number, $40.6 billion. That is the post-closing market cap for the newest AI darling on the block following its final offering price. When a company steps onto the NASDAQ with a valuation of that magnitude, it demands our immediate attention, right? We have to figure out exactly what the market is pricing in here because a $40 billion price tag sets an unbelievably high bar for future performance. So, to make sense of this valuation, we're going to follow a quick roadmap. 1. The AI hardware challenger. 2. Peeking under the hood. 3. The valuation disconnect. 4. Customer concentration risk. And finally, number 5, the road ahead. Okay, section 1, the AI hardware challenger. Let's validate some of this hype. The whole growth thesis here rests on a massive structural shift in the market. According to Causal Trader Equity Research, the addressable market is sitting around $251 million for 2025, but it's projected to just skyrocket to $672 billion by 2029. That's a 28% annual growth rate. And the battleground itself is shifting. It's moving toward production inference workloads, actually running the AI models in the real world, not just training them. This is where Cerebras claims their wafer-scale engine is up to 15 times faster than GPU alternatives. Honestly, that speed advantage, that is exactly the golden ticket they are selling to the market. Moving on to section 2, peeking under the hood, because great tech doesn't always equal a great balance sheet. To keep our due diligence completely grounded, we're looking at raw, verified data compiled by Causal Trader Equity Research, pulled straight from the company's SEC prospectus. So we're not dealing with flashy marketing materials here. We're dealing with the cold, hard, audited numbers from their 424B4 filing. And this brings us to the core financial paradox of this whole IPO. At the top line, the momentum is explosive. Revenue jumped from about $290 million up to $510 million. That's a massive 75.7% year-over-year growth. But there's a catch. Gross margins actually shrink, going from 42.3% down to 39%. And maybe the biggest red flag, that operating loss is widening fast, growing from roughly $101 million to nearly $146 million. So yeah, they're growing like weeds, but man, it is costing them a fortune to do it. Get this. At the time of filing, Cerebras was burning through $32.7 million in free cash flow every single month, literally burning it to sustain their technological edge. When a company is incinerating capital at that velocity, the market is essentially underwriting a multi-year investment cycle. Investors are crossing their fingers, betting that this crazy cash burn is going to eventually lead to operating scale and better margins way down the line. Section 3, the valuation disconnect. Let's talk about how Wall Street is actually pricing these financials. When we look at expectations framed by enterprise value to revenue multiples, Cerebras is trading at a staggering 66.9 times revenue. Now, put that in perspective for a second. NVIDIA, the undisputed heavyweight champion of the AI boom, is sitting at just 23.9 times. AMD is at 21.8. So Cerebras is commanding a multiple almost 3 times higher than the gold standard of the entire industry. It completely dwarfs its peers, which totally explains why analysts have slapped a massive rich verdict on this valuation. And that creates a seriously stark contrast. The final IPO offering price settled at $185 a share. But when analysts run a discounted cash flow model calibrated right to the company's own disclosed numbers, they come up with a fair value of just $49.34. That is a massive 73% discount to the IPO price. Basically, to justify $185, you have to assume a path to margin expansion and revenue growth that simply is not visible right now. The market is pricing in absolute, literal perfection. Which leads us perfectly into section 4, the customer concentration risk. Because in the real world, flawless execution is incredibly rare. When you have a premium valuation like this, any tiny misstep gets punished brutally. And SEC filings highlight a frankly terrifying vulnerability. Roughly 86% of the company's $510 million in revenue comes from essentially one single client in the UAE. Just let that sink in for a second. Nearly 9 out of every $10 rolling into the business relies on one relationship. If that account asks for a discount, delays an order, or worst case, walks away, the downside risk for the stock is just huge. And honestly, that's just the tip of the iceberg. Analysts have put together this rapid-fire risk radar of existential threats. First, manufacturing complexity. Building wafer-scale silicon is quite literally pushing the boundaries of physics. Second, there's a looming 180-day lockup expiration, which is going to suddenly flood the market with shares. Third, expanding into the cloud requires insane amounts of data center capital. And finally, AI investments are super pro-cyclical. If the broader economy even slightly taps the brakes, infrastructure spending could just freeze up overnight. Finally, Section 5, the road ahead. How does management actually plan to justify this sky-high valuation? While the big aspirational narrative here relies on the cloud. S&P Global estimates that cloud growth is supposed to power 2/3 of Cerebras' revenue by 2026. This transition is super important because moving to cloud consumption shifts them away from those chunky, unpredictable hardware sales and towards sweet, high-margin, recurring revenue. It sounds great, but remember, this cloud business is still basically in its infancy. So it all comes down to the ultimate litmus test, which the analysts at Techie nailed perfectly. Now, Cerebras claims they have a jaw-dropping $24.6 billion backlog. Sounds incredible, right? But as Techie puts it, every one of those targets, though, rests on the same two assumptions, that the backlog converts and the customer base widens. If they can't prove there are more than just a one-trick, one-customer pony, those bullish scenarios fall apart. And that brings us to the upcoming June 23rd earnings call, their very first major public test. Forget about short-term per-share profit for a minute. This is the only question that matters. Will that massive $24.6 billion backlog actually convert into real dollars? And will we see the customer base meaningfully expand beyond that single UAE account? That is the ultimate test of value that every single investor needs an answer to. Thanks so much for joining me on this explainer, and definitely keep your eyes peeled for that next earnings report.